Welcome to Multiple Perspectives. This is your weekend view where we bring you the latest insights and trends in real estate investing. I'm Ashley Shoemaker. Over the past week, we've seen news from the retail sector that may seem on its face contradictory. While headlines highlight recent retailer bankruptcies, constraints in retail inventory remain. That is to say, in spite of some big-name businesses folding, there's a silver lining for real estate investors and landlords. Big names like Red Lobster, Express, Rue 21, and Ted Baker are among those who had to shutter many of their stores. But here's where it gets interesting. Despite these closures, available retail space remains near record lows. Landlords are finding it easier than ever to replace departing tenants with new, more successful retailers who are willing to pay higher rents. For example, Kimco Realty, which owns one of Red Lobster's locations set to close, has already received multiple inquiries from potential tenants, including Raising Cane's, Dutch Bros, and Fifth Third Bank. The U.S. retail vacancy rate is currently at a near record low of 4.1%. This high demand for retail space is largely due to years of minimal new construction and sustained interest from new tenants. Since the financial crisis of 2008, and more recently the pandemic, new retail construction has significantly decreased. High cost of land, construction, and labor have further deterred new developments, making existing spaces even more valuable. In fact, Kimco's CEO, Connor Flynn, noted that rents would need to increase by about 35% to justify a wave of new retail construction. The situation creates a robust environment for landlords, who can now attract higher-paying tenants without the need for costly and time-consuming space subdivisions. Economic pressures, such as high interest rates and inflation, are certainly impacting the retail sector. Restaurants, which led retail openings post-pandemic, are now facing challenges due to higher prices deterring customers. This was highlighted by Red Lobster's recent bankruptcy filing. However, these pressures are not deterring landlords. They see the current landscape as an opportunity rather than a setback. For example, Kite Realty Group has already signed leases or is negotiating for nearly all of almost 24 Bed Bath & Beyond stores in its portfolio that recently closed. This strong demand for retail space means landlords can quickly fill vacancies with successful tenants, ensuring continued revenue and foot traffic for their shopping centers. While the rise in retailer bankruptcies poses challenges, it also opens doors for savvy real estate investors and landlords. The combination of high demand, low vacancy rates, and minimal new construction creates a prime environment for replacing departing tenants with more profitable ones. For investors, this trend signals a unique opportunity to capitalize on the resilient retail real estate market. One such opportunity has recently been launched on the EquityMultiple platform, a value-add retail investment in Charleston, South Carolina. For more information about this or any other opportunity from EquityMultiple, reach out to ir@equitymultiple.com or check the show notes. Thanks for listening. We'll be back in your feed next week with another weekend view from EquityMultiple.
This communication is not to be construed as an offer to sell or the solicitation of an offer to buy any security or provide investment advice. Any such offer or solicitation can only be made by means of the delivery of a confidential private offering memorandum. To the extent that performance information is contained in this podcast, past performance is not necessarily indicative of the future results, and all figures are estimated and unaudited unless otherwise noted.